Welcome to Ray Dalio Warning. Please like, subscribe, and share.
What if I told you that while everyone's obsessing over Bitcoin and gold, there's a quiet signal flashing red in the silver market? And Ray Dalio's portfolio positioning suggests he's already moved. If you're ignoring silver right now, you might be missing the most explosive wealth transfer opportunity of this decade. Because what's happening in the silver market isn't just unusual, it's unprecedented, and the clock is ticking. Ray Dalio, the billionaire investor and founder of Bridgewater Associates, the world's largest hedge fund, has spent decades studying economic cycles, currency debasement, and asset correlation. His all-weather portfolio strategy has weathered every storm from the 2008 crisis to the pandemic crash. And right now, Dalio's principles are pointing towards something critical, a structural shift in how wealth is stored and protected. In this video, we'll break down why silver, often dismissed as gold's cheaper cousin, is flashing signals that align perfectly with Dalio's warnings about debt cycles, currency devaluation, and the coming economic reset. You'll discover why industrial demand is colliding with investment demand in ways we haven't seen since the 1970s, why central banks' actions are inadvertently creating a silver supply crisis, and what this means for your portfolio in 2026 and beyond. This isn't about speculation. This is about understanding the macro forces that Dalio has built his entire investment philosophy around, and recognizing when those forces converge on a single asset. To understand why silver matters now, you need to grasp one of Dalio's core frameworks, the long-term debt cycle. Every 75 to 100 years, economies accumulate so much debt that traditional monetary policy stops working. Interest rates can't be lowered enough to stimulate growth without triggering currency collapse. Dalio calls this the end of the long-term debt cycle, and we're there. Since 2008. Global debt has exploded from $200 trillion to over $315 trillion. Central banks have printed unprecedented amounts of currency, driving real interest rates negative for extended periods. History shows us what happens next. Investors flee to hard assets. In the 1970s, when the dollar was severed from gold and inflation surged, silver went from $150 to $50 per ounce, a 200% return. Gold went up tenfold, but silver exploded. Here's the critical difference between then and now. In the 1970s, silver was primarily a monetary metal. Today, it's also an industrial necessity. Solar panels, electric vehicles, 5G infrastructure, medical equipment all require silver. And unlike gold, which can be recycled efficiently, industrial silver is consumed and lost. This is exactly why Dalio's warning about the changing world order matters now, because what we're witnessing isn't just monetary, it's structural. First, Dalio believes that when debt cycles reach their zenith, hard assets with supply constraints become the ultimate wealth preservers. And silver's supply situation is approaching critical. Here's what most people don't realize: we're facing a perfect storm. The Silver Institute reports that 2024 marked the fourth consecutive year of physical silver deficits, meaning more silver was consumed than mined. We're drawing down above ground inventories at an accelerating rate. Meanwhile, major silver mines are depleting. The average ore grade has declined by over 30% in the past 2 decades. It takes more effort, more energy, and more capital to extract the same amount of silver. But here's where it gets critical: industrial demand is exploding. A single solar panel requires approximately 20 grams of silver. Global solar capacity is projected to triple by 2030. Electric vehicles use significantly more silver than traditional cars, up to 40 ounces per vehicle in some models. The green energy transition alone could consume 85% of current annual silver production by 2030. Ray Dalio has repeatedly emphasized diversification into stores of wealth that central banks can't print. He specifically mentions gold But the same logic applies even more forcefully to silver because silver has dual demand, monetary and industrial. So what happens if investment demand surges while industrial demand remains structurally high? You get a supply shock. This means if you're holding only traditional assets, stocks, bonds, cash, you could face a scenario where your purchasing power erodes precisely when a hard asset like silver becomes prohibitively expensive to acquire. The early movers position themselves before the crowd realizes what's happening. And right now, the crowd is still ignoring silver. But here's where it gets more complex. Dalio's investment philosophy relies heavily on understanding correlations and mean reversion. And there's one ratio screaming louder than any other, the gold to silver ratio. Historically, this ratio averages around 60 to 1, meaning 1 ounce of gold buys about 60 ounces of silver. During stable economic periods, it hovers near this average. During crises, it spikes as investors panic into gold. In March 2020, the ratio hit on 25 to 1, the highest in recorded history. Today, it's hovering around 85 to 1. Here's what that tells us: silver remains historically undervalued relative to gold. When this ratio mean reverts, and history shows it always does, silver doesn't just catch up to gold, it outperforms. In 2011, when the ratio compressed from 70 to 30, silver surged 440% while gold gained 70%. The leverage is asymmetric. Dalio talks about finding uncorrelated assets with asymmetric return profiles. Silver fits perfectly. It correlates with gold during monetary crises, but has industrial demand drivers that gold lacks. This dual nature creates explosive potential when both demand drivers activate simultaneously. On top of that, central banks are now net buyers of gold for the first time in decades, a signal Dalio points to as indicating fiat currency distrust. But here's the twist: central banks can't hoard silver the same way because industrial demand requires constant supply. This means the monetary premium for silver must be carried by individual investors and institutions, not governments. When that realization hits the mainstream, the rush into silver could be self-reinforcing. So far, we've seen a structural supply deficit and a historically stretched gold-silver ratio, which both point to an undervalued asset at an inflection point. And that's not even the scariest part. Now we arrive at the most critical insight. Ray Dalio's holy grail of investing is building a portfolio of 15 uncorrelated return streams. The goal isn't to predict the future, it's to survive and thrive regardless of which scenario unfolds. Dalio's all-weather portfolio traditionally includes stocks, bonds, commodities, and gold, but the traditional 7-5% gold allocation is designed for one purpose: protection against currency debasement and geopolitical instability. Here's where silver becomes crucial. In Dalio's framework, you want assets that perform well across different economic environments: growth, inflation, deflation, and stagnation. Gold performs during inflation and geopolitical stress, but silver performs during those scenarios and during economic growth, because industrial demand rises as economies expand. Imagine it's 2026 scenario 1. Inflation remains persistent, central banks lose credibility, and investors flood into hard assets. Silver explodes as both a monetary hedge and an inflation-protected industrial commodity. Scenario 2, we enter a deflationary recession. Industrial demand weakens, but governments respond with massive green infrastructure spending to stimulate economies. Silver benefits from the fiscal response. Scenario 3, we get stagflation like the 1970s. Silver performs exactly as it did then, outpacing nearly every asset class. What most people don't realize is that silver's dual nature makes it one of the few assets positioned to benefit across multiple macro outcomes. Dalio emphasizes this kind of optionality: assets that don't require you to be precisely right about the future. The window to act is narrowing. Exchange traded products backed by physical silver have seen net inflows accelerating in recent months. Retail investment demand is picking up, and crucially, large institutional players are beginning to position. When the trend becomes obvious, liquidity dries up. Silver markets are thin compared to gold or equities. Large capital inflows move prices exponentially. Here's Dalio's practical recommendation. Adapted for silver, allocate a meaningful but measured percentage of your portfolio to hard assets. He suggests 10-15% in gold and other stores of wealth. Within that allocation, silver deserves consideration not as a replacement for gold, but as a complement. A strategic allocation of 3-7% of your total portfolio into physical silver or silver-backed instruments creates exposure to this convergence without over-concentration. But timing matters. The signal is flashing now, not because silver will explode tomorrow, but because these structural conditions are set. The debt cycle is late stage. The supply deficit is real. The industrial demand is locked in. The valuation relative to gold is stretched. These conditions don't reverse quickly. They build until they break. Ultimately, what does this all mean? It means we're at one of those rare moments where fundamental economics, technical market dynamics, and macro policy all align. Dalio's entire investment philosophy is built on recognizing these convergences before the consensus does. The silver signal isn't about getting rich quick. It's about understanding that when governments destroy currencies to manage debts, when industries demand commodities that can't be printed, and when investors finally wake up to supply constraints, wealth transfers from those who ignore the signals to those who position early. This isn't speculation. It's application of timeless principles to current conditions. In short, Dalio's message is this: don't bet on predictions, bet on principles. Diversify into assets that governments can't inflate away, that have real-world utility, and that are structurally undervalued relative to their fundamentals. Silver checks every box. If you prepare now by allocating a strategic portion of your wealth into physical silver or high-quality silver investments, you could position yourself for significant wealth preservation and growth as this cycle unfolds. If not, you'll be chasing an asset that's already moved, paying premium prices as supply becomes scarce and industrial demand remains relentless. The binary outcome is clear. Early positioning allows you to accumulate at rational prices with manageable risk. Late positioning forces you to buy into momentum at inflated valuations, assuming you can even access physical supply. Ray Dalio's overarching philosophy is about adaptation, understanding the machine, recognizing the cycle phase, and positioning accordingly. Silver is the adaptation play for this phase of the debt cycle. The knowledge is yours. Now it's about execution. The silver signal is flashing. The question is whether you're paying attention. What's your take on this? Are you positioned in silver, or are you waiting for more confirmation? Let us know in the comments below. We want to hear how you're thinking about hard assets in your portfolio. If you found this breakdown valuable and want more insights from the world's top investors like Ray Dalio, Warren Buffett, and Stanley Druckenmiller, subscribe and hit that notification bell. Next time, we'll explore Dalio's latest warnings about the dollar's reserve currency status and what that means for your international diversification strategy. You won't want to miss it.
Thank you for watching. Please subscribe.